Coming up today, stocks finish lower on the back of a bad jobs report, the latest additions to the S&P, a look at interest rate pricing, the EU goes after Google, Elon Musk to be the first trillionaire, how to protect your retirement dreams, and boy oh boy does Too Late Powell got some work to do now. This is where it gets interesting, guys. Let's go. And welcome back, everybody, to the greatest show in the world, the stock market. Once again, a very interesting day here. We've got a lot going on, along with some big rotation happening in some of the largest stocks in the market, all of which I'm going to cover today, along with the latest jobs report, a look at the interest rates market, some of the hottest stocks, and a few other interesting things I want to share with you guys today. So sit back, relax, and lock in. I'm going to get you all up to speed on the biggest and latest developments happening across financial markets so you can make better financial decisions for yourself and your family. First, let's just kick things off with the latest big headlines just hitting the wires as I speak. AAPL and Robinhood have just been added to the S&P 500 index, the largest index in the world with hundreds of billions of dollars tied to it that are now mandated to invest in these stocks. And that's why they're having large moves after hours as I speak. Just looking at the 5-minute chart here of AAPL. This and Robinhood were actually the top two stocks on my list I gave you guys yesterday, of which stocks I thought would be added to the S&P 500 index. And so it turns out I was correct in my top two choices, along with another one as well, with MCore Group also been added. AAPL is a mobile ad tech powerhouse, grown massively, 70% year-over-year growth, fueled by AI enhancements. Stock's up big. Wall Street's been re-rating it, and it's already got a market cap over 160 billion. So it's pretty much the largest stock not to be added into the S&P so far. So that was an obvious choice for the Standard & Poor's committee, along with Robinhood as well. Current market cap around 90 billion. The most popular online broker with millennials. In fact, they've got more millennial customers than all the other major brokers combined, and they've been significantly expanding their product lineup, tokenized US stock, and ETF trading for EU users, and offering more traditional financial banking products along with subscriptions. Their business is on absolute fire, and so congrats to all shareholders and both of these stocks. What a nice way to finish the week. Along with those of you that made some trades on this, congrats to you guys as well. And like I said, stick with me because later on in this video I'm going to show you a list of the other hottest stocks out there, and as usual I'll be sharing both technical and fundamental analysis. But let's just move on to the biggest headline from today's trading, the jobs report. And why that's important is because, as I've been saying lately, we have been seeing a lot of weakness in the US labor market, now getting to levels which are typically associated with recessions. And normally when that's the case, that's really bad for the stock market. Typically when the economy contracts, so does the stock market. But we're actually getting some interesting price action today. Probably noticed the Russell 2000 small cap index actually finished higher. But before I show you that, let me just get you updated with the latest stat. Really bad jobs report. The US economy only created 22,000 jobs for the month of August. Very anemic growth. And in fact, they just revised June's numbers, and that actually came in negative. Apparently, the US economy lost 13,000 jobs in June. Unemployment rate came in as expected at 4.3%, but it's the slowdown in job growth that's the more alarming stat coming out from today, along with that significant downward revision in June numbers. And even though unemployment ticked up just a little bit, why didn't it go higher? It's probably got to do with deportation, limiting the supply of available workers. And so that could likely be playing into what we're seeing here today. Some big structural changes in the US labor market. But nonetheless, we've got the unemployment rate curling up and actually breaking out to a 4-year high. And again, that's normally associated with recessions. So that's the question, isn't it? Are we on the cusp of a recession? Or could it just be a recession in the jobs market, but corporate earnings continues to hold up? I'll touch on that again a bit later on as well. But it is quite alarming that the growth in the jobs market is not only slowing, but we actually saw a contraction back in June. And so as I've been saying for a while now, quite obvious we need to cut rate. And even though we've got inflation stats due out next week, PPI, CPI come Wednesday and Thursday, I think it's all but guaranteed that we are going to get a cut of 25 basis points at least. But now the market's also pricing in the possibility of a double cut, half a percentage point, 50 basis points. And we can see that in the applied probabilities from interest rate futures. Now about a 90% chance the Fed will cut by 25 basis points for the first time this year. But now a 10% chance they could do a double cut. And I think inflation stats next week will play into this. If they come in tame, along with another rise in weekly jobless claims, I think this number is going to go up. Otherwise, if inflation came in a little hot, I think we're still going to get a 25 basis point cut, but we probably won't get the 50. And that's pretty much what I'm betting on myself here on Polymarket, prediction markets. As I've been sharing with you guys over the last month or so, I bet on a 25 basis point cut. But yesterday I had a feeling the jobs report might come in weak and we may see a bump up in the odds for a 50 basis point cut. So I took a few profits off the table on a 25 cut and I added that to my bet on a 50 basis point cut, which is now sitting in line with Fed Fund futures at about 10% odds. And I managed to average in at 4.6. So if the Fed Fed does cut by 50 basis points, I'll stand to win $11,500. Otherwise, if they do go 25 basis points, I'll win $2,300. But I very well do a few more trades around this over the next week and a half before the Fed meets on the 17th. And on a side note, I've got to say I'm really enjoying the poly market platform, prediction markets, which have seen huge growth this year. And so I decided back in April to get into it myself. Dipped my toes in the water and I deposited $3,000 to test it out. Really enjoying the platform. It's really clean and transparent. Runs on top of USD coin, the stable coin. You're not playing against the house, but rather other players, and operates like the stock market with a limit order book. You can provide liquidity, and I'm happy to see I've already made a bit over 50% since April, and I'm actually going to start scaling it up and make another deposit next week, along with a few more deposits going forward, and I very well can see myself growing this into a six-figure account next year, as I'm starting to take prediction markets a lot more seriously. Such a great platform for a lot of people out there. Just really simplifies not only financial markets, but sports betting, along with cultural betting, crypto, politics. It's got everything on the platform. And they just got the green light to accept US residents, as Polymarket is the largest prediction market in the world, even bigger than Kelshi. However, just getting back to the rate markets, we've got some interesting dynamics going on out there, especially with US bond yields versus the rest of the world. Quite the divergence, suggesting that Treasury Secretary Scott Bessent is getting his way. His mandate has been lower yields, the lower dollar, and trying to get on top of US debt. And there's a look at the price action in US bond yields today. The market's sending a pretty clear action. Rates are going lower, 407 on the 10-year, and an even bigger dive up the front on the 2-year, testing those lows from early April, 350. What a huge gap between the market and the Fed. And we can see that in this chart here. In the blue line, the 2-year government bond yield. In the white line, the Fed funds rate. And what you'll notice is going back in history, the blue line, the bond market, pretty much always leads the Fed. That's why I always say the Fed's just chasing the market, especially this Fed, with Jay Powell being fixated on the data, looking in the rear view, whereas the market is forward looking. We can see that back in 21. Jay Powell was telling us inflation was transitory. The market was screaming another thing. He eventually caught up. Same with back in 2019. Market rates started dropping earlier than the Fed, and similar story again going into the GFC. The bond market saw it coming. Long story short, we're getting rate cuts. Just how many is the question. And so too late Powell has definitely got some work to do to catch up to the market, try and get out in front of a jobs recession. Market already showing signs of contracting. As for months, he claimed the US labor market was strong. Now we have official confirmation. Pretty much only been weaker during major recessions. Maybe his forecast on inflation will prove just as inaccurate. And so look at that move in TLT today, pushing up above the 200-day moving average, potentially putting in a bottom finally in the bond market, the worst bear market in its 250-year history. Been trying to form a base here for a couple of years on the monthly chart. May just be finally finding its floor. If rates come down, bond prices go up. And that's because old bonds are worth more because they have a higher interest rate than newly issued bonds. And that's why there's an inverse relationship between bond prices and yields. But what's really interesting is the stock market's reaction, something I was looking for today on the back of a weak jobs report. Even though the S&P 500 came off a little bit thanks to some pullbacks in some of its biggest stocks, the Nasdaq as a whole still finished higher. Look at the Russell 2000 small cap index that actually finished up 0.5%. And once again, we're seeing a push up in the relative value of small caps versus large caps. With it too also just getting above its 200-day moving average here. I thought that was interesting that rates getting cut could be the catalyst for small caps to finally catch up to large caps. And we're kind of seeing a bit of similar price action in the interest rate sensitive sectors today. Home builders, one of the best performing, up almost 2%, along with the sensitive sector biotech up over 2%. And no surprise to see real estate stocks, obviously very sensitive to interest rates, also one of the best performing sectors today. And looks like option dealers were bang on yesterday with their pricing. Volatility doesn't seem to mind at all that the jobs market is contracting. It's not spooking fears throughout the market, with the VIX actually falling today to the low 15s. But look at gold, once again ripping higher. What a massive week it has had. Doing even better once again, precious metals miners, once again outperforming the underlying commodity. Same deal with silver. We've seen a massive outperformance of silver miners versus the price of silver over the last month, just moving up really strongly this week, even though for sure we're a little stretched here in the short term. That short-term strength bodes well going forward. And stick with me because later on I'll also show you what else are the best performing ETFs out there today, doing even better than gold and silver. You might be surprised. And so like CNBC host Sarah Eisman said today, maybe the Fed indeed was too late, with a similar sentiment echoed by Mohammed Al-Aran. This data essentially guarantees a 25 basis point cut The weekly report reinforces the view that the Fed should have cut rates sooner, and it may even prompt some discussions about the possibility of a more aggressive 50 basis point cut, which Mohammed currently thinks is about a 25% chance of happening. And I agree with him. I think it's a bit higher probability than what the market's currently pricing at 10%, and hence why I'm still holding my bet on a bigger cut. But let's just see how inflation numbers come in next week, because that's going to move things around a bit. But just looking at real-time pricing in the economy, it's still tracking just under 2%. Keep in mind, the numbers we get from the government are more lagging than trueflation data, so we very well could get a different print. But I'm starting to believe that the market is more and more keen off this data from trueflation than the official prints that we get. We're getting these real lackluster reactions, or really short-lived spikes in the market before reversing. And especially with these huge revisions that we get, I think the market is more and more ignoring the official prints. Or something else could be going on, like I've been suggesting lately, that divergent. In what's happening in the economy and the stock market, there's no doubt there's weakness in the labor and housing markets, but stock market's pretty much sitting at all-time highs. I mean, look at the VIX today. It actually came off. We just got a horrible jobs report. Is the stock market really not worried about this? And this is a trend that's been in effect for a couple of years now. Looking at the average jobs created per month over the last 4 calendar years, this year it just actually fell by more than 50%. And this number could very well go negative next year, which traditionally would normally see the stock market contract a lot. And so no doubt that's alarming for a lot of people out there. Ramp Capital put it eloquently today. The good news, mortgage rates are probably coming down soon. The bad news, you won't have a job to buy a house, which no doubt is a scary prospect, as we're already seeing robots start to replace jobs. Taxi drivers up on deck with Google's Waymo to begin testing rides in California airports, as they, along with Tesla's robotaxi, roll out at light speed across the country. And just looking at the latest stats, there's apparently around 300,000 taxi drivers in the States. And these stats are 2 years old, but even back in 2023, they still thought we were going to see 13% average yearly job growth. I think in 10 years, there may not be any taxi drivers. It's going to be all robo-taxis, because they're going to be way cheaper than a human-driven vehicle. And this is just one industry that AI and robots is disrupting. But of course, that won't be without bumps in the road. And a big one for American mega-cap tech is the European Union, because they lack large, dominant technology companies. Their strategy is to penalize American companies as a way to raise revenue. We just saw that again today with the EU fining Alphabet $3.5 billion to stop favoring its own advertising technology services. I mean, even just the claim itself sounds ridiculous. Accusing a company of acting in its own favor, not actually breaking a law. And this is the second highest EU penalty against Google, taking its total liabilities in the EU of nearly 10 billion euro. And once again, the US president is calling them out on this, threatening more tariffs in his latest post today, saying Europe today hit another great American company, saying it's very unfair, the American taxpayer will not stand for it, mentioning Apple was forced to pay $17 billion, and this comes at a sensitive time when we're still getting through finalizing trade deals. Just after we had a monster move this week in Google shares, with the CEO actually thanking the president for the antitrust resolution, as the White House just hosted a roundtable of the most prominent tech CEOs last night. But the EU's actions once again reiterate the long-held saying in finance that America innovates, China replicates, and the EU regulates. Maybe they should focus more on incentivizing innovation rather than having a strategy of penalizing others. Instead, they're more focused on importing the third world through their relaxed borders, a strategy that very well could cause the downfall of the EU in addition to the United Kingdom. Also interesting to see that the Tesla robotaxi app has shot to the top of the travel category in the Apple App Store, just after we heard news of a new historic record pay package for Elon Musk. No doubt going to be controversial, as it's worth up to $1 trillion. He's very likely to be the first trillionaire. He's already worth over $250 billion. But to earn it, Musk needs to hit milestones, like turning Tesla into the most valuable company ever and selling 1 million robots. And so it'll be a step-by-step process for him to unlock more shares. The board set this kind of compensation package for him a few times over the years, for which it actually worked out quite well for all involved. So as a shareholder myself, I've got no problem with this. I actually think it's the right move. All humans do what they're incentivized to do. And so this is possibly the strongest incentivization the company can give to him to pull off these big goals, along with helping in succession planning. He's not going to be able to be CEO forever, and the board is worried about potentially losing him. And no doubt, a lot of the mainstream media just paint this all about money, making it out to be greed, whereas actually more to do with him having control of the company over its direction, and more importantly, blocking anybody else from having that leverage. He's the visionary that took it to where it is today, but I still believe the future's even brighter for Tesla. Largely just been selling electric vehicles With some energy storage on the side, I think robotaxi and robots in general will eventually be head and shoulders above those businesses, even though they'll still be around for many more years. And so I know plenty of people will focus on the cost of this pay package. I see it more as an investment, helping Musk to retain control, and plus the market doesn't lie. The best performing mega cap tech significantly outperforming the market, up 3.64% today. And if the overall market holds up, I've got a feeling Tesla's about to break out on the upside, as we've been basing here for a few months. And what about the market as a whole? September is historically the weakest month in the market. S&P 500 continues to kind of just drift sideways, a little bit higher on really low volatility with these seemingly muted reactions to headlines. Doesn't seem to be doing a whole lot. We actually gapped up after the jobs report this morning to brand new all-time highs. Before selling off straight away, the market kind of found its feet a bit before lunch there and ticked up a little bit going into the close. The fear and greed index in neutral territory just after we got another high bearish reading on the AAPL investor sentiment survey. Still plenty of skepticism out there. There's no doubt record valuation have got many investors worried what the forward returns are going to be, especially those that may be in their 50s and 60s approaching retirement or even just started in retirement. American stock market has been on fire for about 15 years now. I still think it's got potentially a few more years left in it. Nobody knows exactly when the secular bull market will end, only that it will eventually. Nothing lasts forever. Something else will start outperforming and there will eventually be another lost decade or two. And so how do we all defend against this? Well, one way is not to ever put all your wealth in just any one market. We all suffer from home bias, with most people too exposed to their home country. Of course, you should always have a few local equities and ETFs. Nothing wrong with that. But to really protect your wealth, you want to be globally diversified across many different asset classes. And that can easily be done with US listed ETFs. Over 4,000 now, given exposure to hundreds of different asset classes around the world. And just looking at the ETF screener here in TradingView, I filtered for funds that have more than 100 million assets under management and traded more than $1 million worth of units this week. Amazingly, there's over 2,000 tradable funds out there. And I just ranked them today by the best performance. Number one coming in, global lithium and battery technology, given exposure to different companies all around the world, and they're climbing following China's announcements of plans to rein in competition in its EV battery and related industries as they're seeking to manage overcapacity. Triggering production curbs. Also ripping up there today, solar stocks, the ETF TAN up 4.8%, with some moves out of India as well, expected to lower installation costs. We've also seen Chinese equities really pick up of late, and of course, the metals and mining space is on absolute fire, and we're seeing a bit of a bump up in long-dated government bonds and even completely different markets like South Africa also doing well today. But with 2,000 plus tradable ETFs, how do we know which ones to buy? Well, one way to do that is with the momentum factor. And just to show you what a simple momentum strategy looks like, at the start of each month, you could rank all tradable ETFs by their 1 year performance, going from the best down. Then you invest in the top 10. No need to look at it for the rest of the month. Come back at the start of next month, rinse and repeat. So you're always holding the best performing ETFs. Now that's a real simple momentum strategy that will outperform pretty much any market in the long run. And this has been well known for quite some time, momentum investing. That stocks that have done well in the past 3 to 12 months often continue to do well. Likewise, those that have done poorly continue to do poorly. In fact, I would say it's almost a universal principle. Isaac Newton discovered it over 300 years ago, saying an object in motion tends to stay in motion, and that momentum begets more momentum. And many academic researchers have proved that the momentum factor is one of the most persistent and robust characteristics in financial market, and not just in stocks either. The Wharton School Finance Department tested the momentum factor in stocks, bonds, currencies, commodities sectors in a 215-year backtest. And just looking at it here, they found significant and persistent excess return from staying invested in the top third momentum assets, and nearly as large an excess return from shorting the bottom third negative momentum asset. And if you think about it, the S&P 500 is kind of a momentum system. You look at the stock that were just added to the index tonight, Robinhood Market. It's had a lot of momentum. That's how it's grown its market cap. Same with AppLovin. It's been a great performing stock for a number of years now. And so the S&P 500 index kind of always stays invested in the biggest stocks. But to become the biggest stock like NVIDIA, you got to have a lot of momentum to begin with in the business and its revenue, and of course in its market cap and stock price. And there is actually a momentum strategy ETF out there from Invesco, and they just run a simple system of investing in the top 100 stocks from the S&P 500 that have the highest momentum scores, just looking at 12-month price changes adjusted for volatility, and just going out to a monthly chart on this ETF. and just overlaying it with the S&P 500. This ETF's been on the market literally 1 month shy of a decade, October 2015. And even though the S&P 500 has had a record outperformance in that time, thanks to its concentration in mega cap tech, which may not always be the same going into the future, the Momentum ETF has outperformed it by over 150%. Just that simple system of rebalancing into the top 100 stocks of the S&P 500, according to their 12-month performance. Even with the slippage of running a large fund, $12 billion, they can't just buy and sell stocks easily as you and I. They have to use order algos to work large orders into the market. So even with the slippage of running a large fund, they've still absolutely smoked the S&P 500, even though that's had a massive outperformance in the same period. So momentum investing does work if consistently applied in the long term. And of course, it's not perfect. There will be volatility, periods of underperformance and drawdowns, but long term, it's been proven to work for over 200 years. It's the most persistent factor, even better than value, quality, size, profitability, and other well-known investment factors. And that's why I invest my retirement account using my own unique momentum strategy that I've backtested, proven that works, and I've actually been running it for almost 3 years. In my retirement account, more than doubling my fund manager's benchmark, keeping a globally diversified portfolio, not leveraged to any one asset class or country, and that served me well in that time, delivering a 58% return. And so if you want to learn more about my unique momentum strategy, along with seeing proof of my returns, then click the link below this video, head on over to my website, clickcapital.io, enter your email address, and you can get instant access to my ebook where I tell the story of how I came about this strategy, what makes my momentum strategy different from the basic strategies out there. And this is something I'm actually going to start using on a brand new account using US listed ETFs with $100,000 of my own money that I'll be launching later this month, in addition to keep running this strategy in my retirement account for the rest of my life. I honestly think it's the most purest investment strategy because, like I talk about in this ebook, no one market is safe from long periods of underperformance. Japanese thought they were invincible in the late 80s, only to have 2 lost decades. Can you imagine all those people that retired in 1990? Adjusted for inflation, they would have seen their entire retirement fund go down 80% or more. America's not invincible either, and although this secular bull market has been running strong for 15 years now, there have been periods in history like the mid-60s going into the early 80s. And again, adjusting for inflation, your purchasing power and your standard of living could have gone backwards whilst you're in retirement. We all know about the huge and massive underperformance of Europe, and emerging markets are a constant boom and bust cycle. And that's why I think it's important to be globally diversified, not too leveraged to any one market. And that's what my strategy achieves, as it's pretty much guaranteed to stay invested in the best performing assets from around the world in a diversified portfolio. So again, if you're interested in learning more about this, click the link below this video, head on over to my website, clickcapital.io, and get this free ebook today. I really think you'll enjoy reading it and learning about why I'm so confident to place a significant portion of my wealth into it, as I truly believe it's the most robust strategy there is. Just getting back to the market and what's moving today. Like I told you guys earlier, I was going to share with you a bunch of stocks. I mentioned at the start of this week, Open Door Technologies. Looked like it had further to go, and it's really melted up this week, starting to get like a bit of a cult surrounding it, led by EMJ Capital, Eric Jackson, hedge fund manager. Another retail favorite coming back, Bed Bath & Beyond, that's going to transition to just the brand Beyond. Is actually planning to reopen dozens of physical stores. Another retail favorite today, Loan Depot, up 26%. Citron Research coming out with a bullish argument the market's mispricing this company, and I think along with the prospect of lower rates, that's a great tailwind for mortgage lenders, as they're likely to see an uptick in new loan demand in addition to refinancing activity. Seen some other big moves in tech stocks today. Microsoft falling. CEO Satya Nadella just offloaded $75 million worth of shares. Also saw AMD come off a bit hard, 6.5%, as Broadcom just won a deal, partnering with OpenAI, ChatGPT maker, to build custom AI chips for them, securing a $10 billion order. It looks like the market's also a little nervous on NVIDIA, finding new monthly lows today, down 2.7%, as there's still a bit of back and forth over its ability to sell into China. And even though EU regulators, once again, are coming after Alphabet, that didn't dent investor enthusiasm for the stock here once again today, breaking out to brand new all-time highs, $2.35 a share. And once again, they only make a cap tech stock at all-time highs. And that's pretty much a wrap for the daily market review this week, guys. Thanks very much for sticking with Click Capital. Next week could be an interesting one. PPI Wednesday, CPI inflation Thursday. Market will be looking for that to come in line and may actually start potentially pricing in a 50 basis point cut, which the bond market looks to be getting a bit of a jolt today after that jobs report. So if inflation comes in soft, I expect pricing for a 50 basis point cut to rise. Doesn't mean we're going to get it, but it very well could get into a situation of a 50-50, but we very well should definitely get a 25 basis point cut when the Fed meets the week after next. So that's pretty much going to be the dominant theme in markets until then. Otherwise, for the here and now, metals and mining continues to be the space to be in. Very strong, moving up here. And if you want to learn more about how I invest into ETFs, then click the link below this video, head on over to clickcapital.io and get my free ebook where I describe my global all-weather ETF investing strategy. It's about a 15-minute read, and I think you'll get a lot out of it. And after reading it, you'll understand why I'm planning to invest like this for the rest of my life. So give that a read over the weekend, and I'll see you back here at Click Capital come Monday night. Cheers.